Are you a professional pillow fighter? Or a 9-to-5 low-cost time travel agent? Or maybe real estate sales on Mars is your profession? It doesn't matter. Whatever it is you do, however complex or intricate, Monday.com can help you organize, orchestrate, and make it more efficient. Monday.com is the one centralized platform for everything work-related. And with Monday.com, work is just easier. Monday.com, for whatever you run. Go to Monday.com to learn more.
O'Reilly. You need parts? O'Reilly Auto Parts has parts. Need them fast? We've got fast. No matter what you need, we have thousands of professional parts people doing their part to make sure you have it. Product availability. Just one part that makes O'Reilly stand apart. The professional parts people. O'Reilly Auto Parts.
Welcome back to another episode of Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to discuss Vice President Kamala Harris's proposal for a capital gains tax, what that means, and how it will impact investors. Before we get into unpacking the tax proposal, I first want to clarify what are capital gains. Capital gains are profit that is earned from the sale of an asset that has increased in value over a period of time. However, it is important to differentiate capital gains that have been realized and capital gains that have been unrealized. Let's talk about the difference. Realized capital gains is when you have sold an asset and therefore realized the gain. You have made it real. It is now gone from something that was simply on paper to a transaction where you have money in hand and you have profited from this investment. As an example, let's say that you purchased a share of XYZ stock for $100. And let's say that the stock goes up to $150 and you decide that you are going to close out on this investment. So you're going to sell the share for $150, which is its current value. You sell the share and you receive $150. You have now realized a gain of $50. Your profit from your $100 investment is $50. You must be taxed on those $50. Now, an unrealized gain is a gain that you have on your investment that is unreal, essentially. It is not real because you haven't closed it out. On paper, the asset has grown in value. Same scenario. You invested $100 on XYZ stock. The investment grows up to $150. Your asset is now worth $150, but it is an unrealized asset because you have decided that you are going to continue to hold the position because you are smart, you've done your research, and you're patient, and you have conviction that the asset is going to grow in its value much more than $150. So you want to hold on to the asset. But as of right now, the timestamp, that asset has increased in value by $50. So you have unrealized gains of $50 on a $100 investment. That is the difference between unrealized capital gains and realized capital gains. Now I want to talk to you about the tax implications on capital gains, which I feel like is a very important part to really grasping the policy that Vice President Kamala Harris is working to introduce. As it stands right now, when you have unrealized gains in an investment, there are 0 tax implications. Your investment can continue to grow and generate an increase in value, but you will not be taxed on the growth of that investment. You are not taxed until the investment is sold, once you have realized that investment. On a side note here, I want to discuss the tax rates on capital gains because there are 2 different tax rates, and I feel like it's important to also share the difference in the tax rates. So there are long-term capital gains and short-term capital gains. Long-term capital gains have a lower tax rate, and short-term capital gains have the same type of tax rate as if you were earning income. Holding an asset for longer than a year will trigger a long-term capital gains tax. Let's look at what that entails exactly. I am going to round all of these numbers out so that it is an easier listening experience when I'm giving you these numbers. You can check to see how much annual income is implicated if you Google long-term capital gains tax rates. These change every year, so it is a good idea for us to look at them year after year. Now, for a single person making anywhere from $0 a year to $47,000 a year, you pay 0% in taxes. For anyone making $47,000 a year to $518 a year, you only pay 15% in taxes, which is most Americans are within that tax bracket from $47,000 a year to $518,000 a year. Only 15% is paid in taxes. For anyone making over $518,000 a year and beyond, the tax penalty on an investment is only 20%. This is really important because if you have a short-term investment, you are going to pay so much more in taxes. You are going to pay as if you earned income throughout the year. So let's take a look at what those taxes are. For anyone that makes over $11,000, you will pay 12% in taxes. For anyone that makes over $47,000, 22% in taxes. Over $100,000, 24% in taxes. Over $191,000 a year, 32% in taxes. And so on and so forth. It continues to go up to 37% in taxes. So you can see that there is an incentive for people to begin investing because you pay less taxes. It is much more beneficial to put our money to work. It is much more efficient to put our money to work than to exchange our time for money. Taxes is one of the biggest liabilities that Americans face, and yet we don't look at it as a liability. This is why it is so important for us to become investors. Another very important part to understanding Vice President Kamala Harris's proposal is also understanding net worth. The real benefit of investing in assets is not necessarily the lower tax implications if you hold the investment for longer than a year. The real benefit is holding the asset forever. This is, of course, assuming that the asset is going to continue to grow. If you know that the asset is not going to continue to grow, then what you do is you sell the asset, cash out, pay your capital gains tax, and potentially, if you're able to, reinvest that money into another asset that can continue growing. However, if you can find an investment that will continue to grow for many years to come, then you have essentially struck a gold mine. This is very similar to Warren Buffett's investment strategy, where he holds investments for as long as he possibly can. Warren Buffett is a timely example. I should disclose that he has been selling out of Bank of America shares that have recently made really big headlines because he has sold out of $6 billion. We don't exactly know Warren Buffett's strategy as to why he has made this decision. It could be that he has identified another investment, and so he's moving capital out of this investment to pour into something else. It could be that he sees a problem with the economy and is wanting to keep cash on hand. That doesn't take away from the fact that Warren Buffett is a long-term investor and will hold as long as possible. It's also extremely important to note that while he has sold out of $6 billion worth of shares in Bank of America, he still holds an 11.4% stake in the company, which is extremely large investment to have. His total investment is worth $36 billion. And so selling out of $6 billion is really not that much compared to how much he has in that specific company. Let's go back to holding the asset forever. What happens when you hold the asset for a really long time is that the asset is increasing in value, and that increase in value is adding to your overall net worth without you having to pay any capital gains taxes. When I first purchased my house, it really put this into perspective. You have to remember that I am self-taught, and so I'm learning as I move through the process, as I do my research. And when I first applied for the mortgage application, and I realized how much of an impact my portfolio, my stock portfolio, was going to have on the approval process, that was so impactful. It made me understand why there are so many wealthy people that hold on to their assets, because not only is the asset continue to grow, you don't have to pay capital gains tax, and it is part of your net worth. And so there isn't really an incentive to cash out of your investments. Wealthy people have a very popular tax strategy called buy, borrow, die. They buy assets and they start to borrow against the value of those assets. This is very important for us to process. They start to borrow against the value of those assets. If the value of the assets 2 years from now drop, it does not matter. You have already borrowed from the value 2 years prior when the asset was doing great. Very similar to what I did in 2020, my portfolio had skyrocketed. I applied for a mortgage application. I borrowed money against a very high portfolio. The portfolio ended up dropping in 2021 alongside everyone else's portfolio because the market dropped. The bank didn't say, hey, your portfolio is no longer valued at what it was in 2020. You have to give us the money back. No, the money was borrowed. This is a strategy. Buy, borrow, die. The last step to this strategy is that they then give those assets to their descendants, to their heirs. They die, it's inherited, and the asset never incurs taxes. Taxes are never paid on that asset, no matter how much the asset grew. Once it is transferred over to the heir, there are no taxes to be paid. It's very important for us to understand that just because this is a tax strategy that is deployed by the wealthy, it doesn't mean that we can't begin to apply this strategy at our own capacity, whatever that means to us, whatever size portfolio, however much money you're able to borrow against that portfolio, we can use these tax strategies as well.
At your job, do you ever have to deal with a nose roller? How about a snub pulley? Well, if you're installing a new conveyor belt system, dealing with the different components can sound like you're speaking a foreign language. Luckily, you've got a team ready to help. Grainger's technical product specialists are fluent in maintenance, repair, and operations. So whenever you want to talk shop, just reach out. Call, click Grainger.com, or just stop by. Grainger, for the ones who get it done.
Now that we understand capital gains, unrealized capital gains, the benefits of having an asset portfolio, let's go ahead and discuss Vice President Kamala Harris's proposal on taxing the ultra wealthy. The vice president is proposing that we begin taxing on unrealized capital gains. This has never been done before. It's really important for me to make it very clear that this will only affect people whose net worth is at least $100 million. So if they have $100 million in assets and those assets increase in value, then they will be taxed on unrealized capital gains. So either way, if they realize or keep the asset as unrealized, they will be taxed. And the proposal is to tax 28%. This is going to impact the top 1%. Henley and Partners has reported that that is approximately 10,660 people in the United States. The buy, borrow, die tax strategy is absolutely criticized, rightfully so, by some economists and tax experts as it is seen as a loophole for the wealthy. Most normal folks aren't taking advantage of these types of strategies, but also we don't get to nearly benefit as much as the wealthy do. Like, we are paying so much in taxes, and so the disparity is quite large. This is really what is to blame for the difference between the haves and the have-nots. And so it is important that we address this loophole and I think start to work in rectifying this. We talked about this in an episode early this year that we'll be sure to link in the show notes, where some of the top 1% are actually begging to be taxed at a higher rate. However, they are not looking for their unrealized gains to be taxed. I think they're looking for their earned income to be taxed at a higher rate. Now, there is a lot of criticism when looking at this tax policy, and of course there is. It's something that has never been done before. There's also speculation on how this can potentially affect more people down the line. It's not going to affect us directly, but there is speculation that this can eventually begin to affect those with a smaller net worth. So are we opening the door for it to eventually affect small investors like us? To me, that type of criticism is rooted in pure speculation. We can speculate on any policy change for fear of what might happen in the future. I think where there's a little bit of a more valid criticism is given the fluctuations in the market. So heavy criticism is coming from folks that are saying, while it's clear that 28% will be taxed on a portfolio if that portfolio goes up in value, what happens in the following year if the market goes down? Will they then have a tax credit that is given back to them on their losses? I think these are all valid questions that need to be ironed out, but I also think that we are more than capable of figuring out a solution when we have volatility in the market. We should also acknowledge that President Biden did attempt to pass this policy. His policy, however, was at 40% tax on unrealized capital gains. That policy did not pass. While we're at it, we should also disclose that we do have some Democratic members like Nancy Pelosi that are worth more than $100 million. It will be interesting to see if she is able to get this done, given that Biden was unable to, although she has come down, I would say, pretty significantly in the amount that would be taxed. There has been so much misinformation pertaining to this policy. Hopefully today gave you some clarification on who exactly this is going to affect. You're listening to Investies, a Cosmic Standard and In Luz We Trust production. I'm your host, Linda Garcia. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
At Nutrafol, we don't just help your hair, we help your body grow it. Because it's never just about your hair. It can be your job, or your deodorant, or your lunch, or just normal life. That's why our whole body approach targets the key root causes of hair thinning. Discover your root causes and why we're the #1 dermatologist recommended hair growth supplement brand at Nutrafol.com. That's Nutrafol.com. These statements have not been approved by the FDA. This product is not intended to diagnose, treat, cure, or prevent any disease paid for by Nutraceutical Wellness, Inc.